Indian currency touched yet another fresh low today, as low as 72.67 and merely rising up to 72.45 at close of day. Is this a start of a slippery slope? Is this becoming a scary slope? Hello and welcome to our special show, Rupee, the Fear Factor. I'm Latha, Venkatesh. Well, the Indian currency is beginning to look scary primarily because of the events of the weekend. First up, today in early trade, while the offshore market, where, what you call the non-deliverable forwards market showed that the rupee may not fall so much, at the start itself, the rupee in the domestic market started falling more simply because there was a goodish bit of importer demand. So clearly it's domestic market that's buying the dollar in a bit of a scare. The other reason why one is a little worried about the fall today is that over the weekend, the government started talking up the rupee. Until now, you heard Finance Ministry largely saying that, a fall is welcome. It corrects the deficit and the market knows best and the RBI knows best. Now, clearly, the government thinks that enough is enough. RBI actually walked the talk. While the government said that the rupee had fallen enough, both on Friday and on Monday, we hear from dealers that there was a goodish bit of dollar selling by the Reserve Bank. The rupee did go off lows, but at higher levels, it continued to find selling. And hence this fear that is this now getting to be a slippery slope. Let me quickly tell you the global ambience in which this is coming. It's not very positive. This does look like an emerging market contagion, as we have put it. There are two things which are roiling emerging markets. The trade tariff talk is pushing emerging markets down because a lot of Asian EMs are actually suppliers to China. They're part of the supply chain, and therefore a further $267 billion of tariffs on China doesn't bode well for them. The other factor hurting EM currencies is the possible strength in the dollar because of the strength in the US economy. The very strong jobs data that we saw pushed the dollar index up a bit, and that always means that EM currencies, in comparison, will fall. And, now it is actually two factors. In the days of yore, whenever the US economy did well, like in the 2003 to 2007 period, as the US economy grows, Asian EMs are able to take a strong dollar because they're exporting to this big economy. But now with the US economy growing but saying that we don't want goods from EM countries, it's a double whammy for currencies like, the Korean won. The Korean won fell rather sharply today, 0.6. And of course, the other currencies, the peso, the rupee have all been falling. I mean, forget the month to date. Look at the year to date fall. Rupee has fallen 13.4%. The other currencies, Korean won, 5.7, peso, 7.7 or 7.8. That's the Filipino peso, not Argentinian peso. I'm only comparing it to Asian countries. And then we come to the others. With this company, we look a little better, of course. But we don't want to look better than just these guys. We want to look better than Asian currencies. So the Brazilian real, the South African rand and the lira are, of course, much worse. But the Indian currency, being the worst performer in the Asian EM basket, is that a spot of bother now? Or is it just making up for, the last 3 or 4 years of very good performance? And, therefore, in comparison to 2013, for instance, we still look very good. Should we be happy or should we be scared? Let's ask the first of our experts. We've got actually a band of experts joining us. First up is B Prasanna, Head Global Markets at ICICI Bank. Prasanna, thank you very much for joining us. That really is the first question. Should we just, until now, both from North Block and in the markets, economists were telling us, yes, we were too steady for too long, and now we have to correct, fall a little to correct our trade deficit. Are we overshooting, or are you still comfortable?
So, Latha, I was hearing your opening commentary just at the beginning of the show, and I think you hit the nail on its head. Basically, it's a double whammy which is going on. Something that I wanted to say, actually, you hijacked what I wanted to say. So you have, over the weekend, the strong non-farm payrolls data which came out of the US, which actually led to the US index appreciating, the dollar appreciating over all other G7, G3 currencies. And then basically because the growth is expected to be very good in the US, and not only the labor data, but also the wage growth came on the higher side, basically indicating that the Fed is going to be very much on its trajectory of hiking rates, possibly 2 more this year and 3 more next year. These things are still not priced into the rates market as yet, as well as into the Dolex market as well. So you have an appreciating dollar on one hand, which effectively, I mean, it's a economy, US economy, which is doing well. And like you rightly said, normally it means very good growth for emerging markets, and hence it means countries like India should be doing very well. But unfortunately, what we have on the other hand, along with an appreciating dollar and a rising rates, is the fact that there is a huge trade war which is blowing out. You really don't know who are going to be the winners and losers in this. Of course, it is a US-China trade war primarily, but there are going to be a lot of ancillary players because there are a lot of people in the global value chain which provide imports and exports to the Chinese economy as well as to the global economy. So it is really a concoction of sorts, and because of which the entire flows into emerging market is getting questioned, and there is a reassessment of the various asset classes by the foreign investors at various places. So this has kind of led to a big sell-off in emerging market currencies this year, and which is actually accentuated in the last 1 month. So if you really look at this year, you would see that, I mean, countries like Argentina and Turkey has possibly done the worst. They have probably depreciated 60% to 40%, depending upon which country you take. But then if you take the other countries like Brazil, Russia, and South Africa, they have also appreciated in the high teens, 18%, 19%. So India was in the low or in the high single digits till around last week. But right now, I think if you calculate the depreciation, it would be in the region of 11 to 13, 12 to 13%, depending upon what you look at.
Prasanna,
so the point...
I want to interrupt you here because, I take your point that now we are beginning to look a little bad if you look at double-digit percentage fall. I have a bunch of emerging market experts joining me a little later on the show to discuss the EM context. But I'm really worried about the India context, and you are best placed to answer that. See, there is a double whammy hitting Indian economy because of this. There are some companies which are deeply dependent on imports or have FCCB, ECB exposures. And also, where did the bond yield end today? 8.16. So do you think now there is a self-fulfilling negative for the Indian corporate sector?
So, Latha, what we are going through right now is the reverse of a virtuous cycle, vicious cycle, if you want to call it. So you don't know, all asset classes are falling, and you don't know which one is driving what. So, I mean, equity is falling, currency is falling, and bond yields are looking at both those markets, and yields are going up. And then at somewhere, yields are going up, and equity is falling, looking at the bond yields going up. So this is become a very vicious kind of a cycle. And but like you rightly also said, that the government has come out with very, very positive statements over the weekend, saying that they are not really appreciative of this extent of rupee depreciation, which is a slight change from the kind of narrative that they were talking about last week, which was to say that they were probably comfortable because it was a global market phenomena. So to some extent, see, you can't call in the market what exactly is the right level, or even if you were to know or have in mind what a right level is, you cannot expect the market to exactly stop at that level. Obviously, markets are being markets. They will overshoot or undershoot. And we had, over a period of time, over the last 4-5 years, consistent periods of time when we have current account deficit, but we were supported by the foreign flows, and hence our rupee did appreciate. So you could possibly say that we are catching up for the past lack of depreciation that happened in a few years. So it's a mix of all these factors that are really going through. And I think market at some level would possibly find a fair level. Say, even right now, I can tell you a lot of foreign investors are looking at bond markets with an attractive eye. They want to get into the market, but they're saying that let the currency market stabilize. So clearly, one asset class is driving the asset class. If there is stability in the currency market, I'm sure that there will be some kind of inflows which will come back in. So what the currency market incidentally is doing to the bond markets is there is some kind of a doubt which is coming into the market's mind as to whether a repeat of 2013 is likely or not, which is an interest rate defense. So if you see last time around, it was first the RBI did the interest rate defense first, and then came out with the FCNRB deposit scheme later on. So the fear in the minds of the bond market participants today is this currency fall going to lead to some kind of a rethinking from the Reserve Bank from an interest rate perspective? Ironically, we are in a time when inflation is quite comfortable. I mean, in the sense that, of course, it's 5, which is still higher than the 4, which RBI is targeting. But it's not that it's a runaway inflation. So the net rate hike is not going to happen due to inflationary expectations going out of bound. It's possibly, if at all, going to happen because of the financial instability caused by the emerging market crisis and the rupee depreciation.
Okay. Well, personally, would you endorse either of these positions or even expect them from the Reserve Bank? I mean, we have $428 billion of reserves. I mean, is this just wishful thinking by some of the foreign banks who made money hand over fist last time around at the NRI bonds were issued in 2013? Either of these out of turn hike or bond, is that on your radar at all? Are you expecting it?
So if your question is that is an FCNRB kind of a scheme which was given out in 2013 likely this time? So I'm sure, I mean, I have to repeat what the government official said, which is that all options are on the table and they've included FCNRB scheme also as one of the possible solution. But in my pecking order, I would possibly place things like measures to improve the current account deficit, like measures to, bring down imports and encourage exports. Any of those measures should come first. Oil window, currency window for the oil companies separately from Reserve Bank of India, that will probably come second. And then somewhere in between, you can also think about the Reserve Bank of India intervening more aggressively in the spot market by using its reserves to sell in the spot market, and also doing a bit of buy-sell swaps, which is to receive forwards in the forward market to postpone the liquidity suction to a future date. So I think these three, mix and match of all these three, I would say is a little on the higher probability when compared to an FCNRB scheme. But the FCNRB scheme also, as told by the government official, seems to be very much on the cards.
My sense is that a large part of the market is reading the Reserve Bank or expectation of the Reserve Bank exactly as you are saying, that more likely expectations of some action from the government on the imports and exports front. But very quickly, Prasanna, a quick last question, and please try and answer me with some specific ranges. What can be the worst for the rupee? What is a likely equilibrium that you are expecting? And likewise on bonds, is 8.16 bad enough? What can be an overshoot?
No, Latha, it is very difficult to give a specific answer for that. So like I said, markets being markets, they do overextend. So it's very difficult to figure out how much overextension can happen. All I can tell you is that at around 72.5, on a RER basis, the data is still not out, but on a RER basis, I suspect that we are at around 10 to 11% overvaluation, which has been the long-term average. But of course, you can argue that long-term, it's only a long-term average, and you can always go towards 107, 108, which basically means that we go towards 73, half, 74. So I'm not saying it will happen, but it's very much possible. And on the yield side, like I said, see, bond market players are living by the day, and they come in the market, see where oil is and where dollar rupee is going to open, and then they play the bond market accordingly. So clearly, as you come every day and you see oil higher, oil has been higher by around 8 to 10% over the last 1 week to 10 days. So as you see oil higher, and as you see dollar rupee not stabilizing, bond yields will go up. So who's to say what is a fair value? Is it at 8% or 7.75? Okay. Probably a lot of us thought 7.75 to 8 was a fair value, considering 6.5 as the repo rate. By the way, the swap market today is now pricing in 3 rate hikes within the next 1 year, 2 rate hikes in the next 2 policies, plus a 3rd rate hike somewhere 6 months to 9 months down the line. Okay. So as oil goes up, as dollar rupee appreciates, the rate hike expectations is also going higher and higher in the swap market, and this also feeds into your bond market selling, which is happening currently.
Absolutely. Opinions don't make markets as much as markets make opinions, right? Thank you very much, Prasanna, for joining us with your take. So things can get bad simply because, the global ambience in which the rupee and Indian bonds are playing out is now shifting. Exactly that after this very short break. We're going to have 2 guests with us, Nick Parsons and Gareth Leather, to discuss with us how is the global EM scenario and the global scenario playing out. Are we going to see more currency instability? That question in a minute after this break.